So our next question comes from Richard E. via email. Richard says, I'd love your insights on a question that I've been wrestling with. My wife and I are 37, we're debt-free besides our mortgage, and we've always lived below our means. She makes $49,000 a year, I make $75,000 a year, and this is our highest income ever. We have a 6-month emergency fund and a high-yield savings account, and we're trying to begin to build long-term wealth through consistent investing. She has $73,000 in a 401k from her work. I have $72,000 invested in index funds and ETFs with Vanguard. And so here's my question. Now I have $20,000 in a rollover IRA from a previous employer. I'm thinking about converting that $20,000 into my Roth IRA, so transferring those $20,000 into my existing Roth IRA that has $30,000 into it and letting it grow tax-free. Do you think that I should keep it in this pre-tax account, or should I roll it over and pay taxes now and let it grow tax-free? And then, of course, I'll do some weekly automatic deposits and continue to grow money over time. What do you guys think about this? I've learned a ton from your show. Thank you so much. Robert, you want to kick this one off with Richard E?
Absolutely. We love this type of question because at the end of the day, the answer is pretty clear. We don't know what the tax man is going to be doing in 5, 10, or 20 years from now. So we always want to see people get the taxes out of the way now where we know where they're at, and then get the tax-free growth for the rest of the account and until retirement. So that's my answer. It's pretty straightforward. I don't like to mess around with the tax man, so I always want to make sure I know where I stand, get that bill paid. And so we could only assume that in 10, 20, 30 years from now, taxes are going to be higher, and it could be a lot more painful to wait until you're going into retirement to pay the tax bill. That's my take on this question.
Yeah, I'm right there with you. So we were talking with Carlton Dennis, and he was saying if you're making over $300,000 that you should consider thinking about doing a traditional IRA versus a Roth IRA, all that fun stuff. And like in the short term, I'm sure there's some very clear, cut and dry strategies, and maybe there's a formula to consider. I'm over here thinking about, I can't predict the future, right? All those equations and formulas and assumptions, they all assume that the tax rate's going to be the exact same in the future. Well, I don't know if you guys remember this, but we also talked about how the big, beautiful bill just made it so the highest tax bracket, I think, is now 37% versus 39% that it was supposed to go back to. So if you were assuming that it was going to be 37, then it goes up to 39, but the bill wasn't getting passed. Like, there's a lot of things that could have happened that have changed your assumptions in the future. And I guess what I'm trying to get at here is that Robert is correct in the sense that I have no idea what the tax brackets are going to be when I'm 65. I have no idea what they're going to be when I'm 75 or 85 or whatever else in the future. And so, in my opinion, I'd much rather say, I know what my tax bracket is today. I know what that looks like right now, and I'm okay with paying those taxes knowing that these investments will grow throughout the next 40, 50 years of my life and compound tax-free, and I'll be able to take the money out and enjoy it tax-free as well. So if I were you, Richard E., I would convert the $20,000 into the Roth IRA. I'd pay the taxes on that $20,000. You're looking at probably $4,000 to $6,000 of taxes that you would pay. I'd pull that money from your 6-month emergency fund, replenish the 6-month emergency fund, and then get back after it and keep investing. You guys are going to be net worth millionaires in the next 30 years. I promise. You are so on top of it. We could not be more excited for you both.